to the webinar I am hosting tonight. The purpose of this webinar is to help you as a Rio Tinto employee to effectively navigate and manage your own 401k plan. Tons of people have access to 401k plans. Not many people know how they work, and even more people struggle with choosing which investments to use within the 401k. So the whole purpose of this webinar is to help you with those two decisions and hopefully give you a little bit more confidence in contributing and using a 401k to prepare for retirement. So before we get started, let me just tell you a little bit about myself. My name is Kevin Michaels. I work for a financial planning firm here in Draper. It's a fee-only financial planning firm, if that means anything to you. It's called Medicus Wealth Planning. I'm a certified financial planner, otherwise known as a CFP. I'm also an enrolled agent. Not many people know what an EA is. Basically, I'm just a federally authorized tax practitioner. If you get audited by the IRS, there's only a few different types of people who can officially represent you, and that's a CPA, an attorney, or an enrolled agent. I went to school for financial planning. I graduated from UVU with a degree in personal financial planning. And I try to stay pretty active in the financial planning community. I'm on the Board of Public Relations for the Utah chapter of the Financial Planning Association, the FPA. And then I do quite a bit of writing. I enjoy that. So I've been quoted in a few publications. You'll see that at the bottom: MSN Money, Investopedia, NASDAQ, and Utah Business Magazine. So one other thing I want to cover before we get into this webinar is a few disclaimers and disclosures. First off, I have no contract or relationship with Rio Tinto whatsoever, neither does Medicus Wealth Planning. Over the years, we've worked with quite a few clients who do work with Rio Tinto, so we've become pretty familiar with your benefits plan and your 401k package in particular. So throughout this presentation, we'll be talking about the funds available in your plan. We'll also be just talking about general historical returns for stocks and bonds. Please don't construe this as a guarantee of future investment results. It is not. As you know, the stock market goes up and down, and nothing's guaranteed. There's a link here at the bottom of this slide, and those are the official disclosures and disclaimers that Rio Tinto and Principal makes on the 401k plan. So click on that if you're interested. Okay, now that we've gotten through that, let's get into the webinar, the meat and potatoes of this. So what I want to do before I go about teaching you how to choose the funds is just give a general overview on 401k plans and the Rio Tinto plan in particular. So with Rio Tinto, they offer two different types of 401k plans. So they offer the traditional 401k and the Roth 401k. And the only difference between these two accounts, or I guess the main difference between these two accounts, is how they're taxed, okay? So when you put money in the traditional 401k, you will get a tax deduction for that. That means if you make $75,000 and you put $10,000 in your traditional 401k, you will only be taxed on $65,000 of that $75,000 income. So that's an immediate tax benefit right now. With the Roth 401k, you do not get that tax benefit up front. Everything you put into the account has already been taxed. Now the difference comes into play when you start making withdrawals. When the money is sitting in the account, when you're putting money in the 401k and investing, it's all tax deferred. So you won't be taxed on any of the investment gains. But when you start taking money out of the traditional 401k in retirement, it's all going to be taxable. When you start taking money out of the Roth 401k during retirement, it is not taxable. So basically, with the traditional 401k, you're getting a tax break up front, but no tax break on the back end. With the Roth 401k, you are not getting a tax break up front, but you're getting a pretty big tax break on the back end. Another thing you want to keep in mind is required minimum distributions, otherwise known as RMDs. So with the traditional 401k, it is subject to RMDs. And what that means is when you hit a certain age, 70 and a half, the IRS is going to make you pull a certain percentage of your funds out of your traditional 401k. Okay, and they do this simply so they can tax it. So it starts out at about 3.6%. So let's just say you have $1 million in a traditional 401k and you only need to pull out 10,000. Well, the IRS is going to make you pull out around 3.6 of that, which is about 36,000. So like I said, that's something to keep in mind. With the Roth 401k, if you roll it to a Roth IRA, you're not subject to that RMD requirement, which is an added benefit. So this begs the question, what you should be investing, or what should you be investing in? Should you be investing in the traditional or the Roth 401k? And you know, you can go into a really deep analysis, and we do this for our clients where we run a full financial plan and we tell them, you know, in the end, the traditional or Roth is going to be better for you, or a combination of the two. But just as a rule of thumb, usually for those who are in a lower tax bracket now, the Roth is going to make more sense. So I'd say if you're in a 10 or 15% tax bracket, contribute to a Roth 401k. If you're in a 25% tax bracket, I'd probably do some in the traditional and some in the Roth, however you want to split that up. And then if you are in a higher tax bracket than the 25% tax bracket, you're probably going to want to put everything in the traditional 401k. And like I said, this is just a rule of thumb. I'm not too keen on rules of thumb, but just to make things simple, usually this chart works. So 401k contribution limits, those differ depending on your age. If you're under age 50, you're going to be able to put up to $18,000 in your account this year, and that goes up a little bit next year. Between your contributions and Rio Tinto's contributions, it cannot exceed $54,000. Now, if you're over age 50, you're able to put in $6,000 more, so you can put in $24,000, and between you and Rio Tinto, you can put in $60,000. So keep that in mind. Obviously, the more you put in, you know, the more you're going to have it at retirement. The matching by Rio Tinto is pretty generous in a few ways. They do a dollar for dollar match up to 6% of pay. That's 6% of your, that's a 6% raise that you're leaving on the table if you're not putting 6% of your pay into your 401k. The other great benefit is it immediately vests, and what that means is they could put your match in one day and you could quit the next day and you get to keep that full match. Not many companies do that. Usually they have a vesting schedule where you have to stay 2 to 5 years to get all the matching that they put in there. Another thing to keep in mind is even if you're putting money in the Roth 401k, all the matching by Rio Tinto is going to go into the traditional 401k. And it's done that way because they have to do it that way to get their tax deduction. Okay, so we've given you kind of a general overview of the Rio Tinto 401k plan. Let's now provide a framework for how to choose the funds in your 401k. And before we actually talk about the funds available in your plan, we need to make 2 other decisions, okay? So this is a 3-step process. The first step, which is the most important, is choosing your general asset allocation. Now, if you haven't heard that term, asset allocation, or you don't know what it is, don't be intimidated. It's super, super, super simple. All a general asset allocation is how much of your account you have in stock funds and how much you have in bond funds, okay? So stocks and bonds, they work differently, and we'll talk about that. But this is the first choice or first decision you need to make before you invest your 401k. The second decision you have to make is also pretty important, and that's choosing your detailed asset allocation. Okay, so this is also really simple. All you're doing is you're looking at the stock portion of your 401k, and you're saying just generally what type of stocks do I want to invest in? Do I want to invest in really big US companies like Amazon or Apple? Or do I want to invest in international companies or really small companies? There's different assets or stock assets you can invest in. And then you do the same thing with bonds. What kind of bonds do I want to invest in? US bonds or international bonds or you know, high yield bonds, whatever it may be. And we'll get into those segments as well and how those work. And then the last step is to actually look at the funds in your plan and choose which ones you want to do. So I'm going to take you through each one of these steps. Please don't be overwhelmed. naturally I go into a lot of detail, but I'll try and keep it simple. And of course, at the end, I'll give you my email address if you have any questions. So let's start with step one, choosing your general asset allocation. Like I said, this is just choosing how much you're gonna have in stocks versus how much you're gonna have in bonds. Stocks over the long run have had a higher return than bonds, but they also come with a lot more risk. And when I say risk, just think of volatility. You know, stocks are gonna go up quite a bit for a few years, and they're gonna drop, and they're gonna keep going up again, and they're gonna drop, and that's how it works with stocks. With bonds, you're gonna have a lower return over the long run, but it's gonna be a lot more smooth. You're not gonna see a lot of drops, and when you do see a drop in bonds, it's really small, -1 or -2 or -3%. Okay. So this is a stock chart. This is the S&P 500 index. This just represents basically the 500 largest stocks in the United States, okay? And the reason I want to show you this is just to give you a visual representation on the volatility and the growth of stocks, okay? So if you start on this left side in 1990, the year 1990 with a $10,000 investment, all the way until 1999, you just see continuous growth. In fact, a 432% total return for those 9 to 10 years, okay? And then if you remember from 2000 to 2002, the tech bubble bursts, and we had 3 years of negative returns, and the stock market dropped -37%. But then it started climbing up again all the way into the Great Recession in 2008, climbed another 83%. And then in 2008, it dropped again, another 37%. And since then, it's just gone straight up. You know, since 2008, we've seen 194% gain in the stock market. Eventually, we're going to see another one of these big drops, and then it's probably going to climb again, and then drop, and then climb. But this is the nature of stocks. It's volatile, but over the long run, if things perform how they have in the past, you're going to see a pretty good return, okay? Now, bonds are a little bit different. It's just a straight, almost just a straight line with a small growth rate, kind of a flat growth with little declines. There's been 2 declines, maybe 3 declines since 1990, and they've all been less than 3%, okay? Now, if you remember with the stocks, your account grew to about 112,000. With the bonds, you'll see it just grows to 50,000. So you're taking on less risk and you're getting less return. Now, putting these charts together, you kind of get a picture of how both stocks and bonds work. So what we're trying to decide is how much of your account do you want to be subject to the volatility of the stock market? How much of your account do you want to be subject to the volatility or lack of volatility of the bond market? This has a lot to do with how far you are away from retirement and how much risk you can handle, okay? So let me just give you some examples. Don't be overwhelmed by this chart. It's a lot of numbers. I'm just going to take you through a few of them. Then I'm going to ask you to pause this webinar and choose an asset allocation that you're comfortable with, okay? So let's do this. Let's start up here at the top, this dark orange where it says strategy. Starting on the far left, you have aggressive growth, you have moderate growth, balanced, conservative growth, and ultra conservative, okay? And then right below that, it's the asset allocation that's paired with each of these strategies. The more aggressive you want to be, the more you're going to have in stocks. The more conservative you want to be, the more you're going to have in bonds. And if you go down one more column to that average annual return, you'll see over the long term, at least from 1990 until now, the more you have in stocks, the higher your return is going to be. Okay? Now go one more column down to this range of returns. What this is it tells you with a lot of confidence, basically, where you can expect your returns to fall within any given year, okay? So the more you have in stocks, the higher that range is going to be, the more uncertainty there is. The more bonds you have, the more certainty you have in where your annual returns are going to fall. Okay, let's go down one more column to this worst year. Obviously, the more you have in stocks, the harder you were hit in 2008. You were down 37%. If you were all in bonds, the worst year you had from 1990 until now was in 2013 when the bond market was down 3%. Let's go down one more column to this time to recover. This just tells you If you go back to 2008 and you saw that, let's just say you saw a 37% decline, how long it would take you to get that back, get your account bounced back to where it was. Obviously, it's going to take more time if you have more stocks in your account simply because the drop was larger. Okay, so this time to recover is an important statistic to think about when you're getting close to retirement. And I say that because the worst thing you can do is retire during a bear market or a down year. That really hurts the longevity of your retirement savings. Okay, the percent of a positive years is just how often that asset allocation yields a positive return. And then this growth of 10,000 right at the bottom says if you started out with $10,000 in 1990 and used these different asset allocations, how much money would you have today? And obviously, the more you have in stock, the more you'd have today. So what I want you to do now is just pause this webinar, take a look at these numbers and these different strategies, and I just want you to, naturally, you'll just have an inclination towards which one of these you are most comfortable with. And we're just going to use that strategy as a reference going forward. Okay, so once you have that picked out, you can hit play again and we'll continue. Okay, now you've chosen your general asset allocation. Let's talk about your detailed asset allocation. If you remember, all this refers to is how much you're going to invest in your stock portion. It's going to be, sorry, let me start over. Your detailed asset allocation just refers to what type of stocks you're going to invest in within the stock portion of your portfolio and what type of bonds you're going to invest in within the bond portion of your portfolio. Okay, so let's talk about the different type of stocks that you can invest in. There's 4 major categories. You have large U.S. companies, think of the Apples and the Googles, the mid-sized U.S. companies, still very big companies, small-sized U.S. companies, and international companies. Now, starting on the left side, that's the safest bucket of stocks, the large U.S. companies, and the most risky are these international companies. And when I say risky, once again, just referring to the volatility. Now, what I recommend, just as a rule of thumb, is you should include each of these buckets or each of these segments in the stock portion of your portfolio equally, okay? So you'll see all these boxes are the same size. So you should have a quarter in large U.S. companies, a quarter in mid-sized U.S. companies, a quarter in small-sized U.S. companies, and a quarter in international companies. Now, if you want to play around with that a bit and just have more in U.S. companies, that's totally fine. I'm just giving this to you as a rule of thumb that you should probably have all 4 of these categories in the stock portion of your portfolio. Okay? Now, with bonds, there's 2 major categories you should involve, and that's U.S. bonds and international bonds. And unlike the stock portion where I said you should probably have it in there, each category represented equally, I would overweight your U.S. bonds simply because U.S. bonds are, although they probably yield a lower return over the long term than international bonds, are a lot safer. And the reason why we're investing in bonds is for the safety. So I would say probably within the bond portion of your portfolio, 75% should be in U.S. bonds and 25% should be in international bonds. Now, also, like I said before, with the stock portion, you can tinker with this. I'm just kind of giving that to you as a rule of thumb. If you want to have 50% in bonds and 50% in U.S. bonds and 50% in international bonds, that's fine. But normally I would overweight the U.S. bonds. Okay. So just as a summary, with your detailed asset allocation, within the stock portion, you're going to have large U.S. companies, mid-sized U.S. companies, small U.S. companies, and international stock. Within the bond portion, you're going to have U.S. bonds, you're going to have international bonds. And this is how I would structure the detailed asset allocation of your portfolio, okay? So let's just review again. You have, at the top, you're going to have some stocks and some bonds, and then you're going to have these different categories within your stocks and within your bonds, okay? Now this takes us to the 3rd step. We're going to choose the funds to include in our 401k. And I'm going to come back to this. Let me get to this screen real quick. What we're going to do, sorry about that. What we're going to do is we're simply going to fill in these blank squares. We're going to look at the funds in the 401k that invest in large U.S. companies. We're going to find the best one, and we're just going to stick it in that box. Then we're going to look at the funds in the 401k that represent mid-sized U.S. companies. We're going to find the best one or two, and we're going to stick it in that box. And we're just going to continue this process, okay? Now, when you're looking for the funds, keep it simple. You can look at tons of different metrics, but the two I would just look at is the track record on performance. How is the fund compared to its peers in the last 15 years, 10 years, 5 years, and 30-year periods, okay? And then look at the expense ratio, and that's simply how much does it cost to invest in the fund. And this is going to be stated in a percentage format. So, for example, there's one fund in your plan that charges a 0.04% fee. That means that if you have $100,000 in that fund, they're only going to charge you $40 a year. There's also a fund in your plan that charges a 1.06% fee, and they would charge you $1,600 to invest in their fund. So that's something to keep in mind, okay? All right, so let's start with large U.S. companies. What funds in your plan represent large U.S. companies? You have 3, okay? And what I want you to pay attention to now is this asset class, okay? So you'll see each of these asset classes start with large, but you have a large value, a large growth, and a large bet blend. Real quick, value or large value companies are just ones that have grown really big and pay a steady dividend, and they're pretty, you know, they're not going to grow. The price isn't going to shoot through the roof. They're just a pretty big, stable company. Large growth companies, as you see down here, are companies that are big but still have a lot of room for growth, okay? And then blend is just a fund that invests in both value and growth, okay? So if you have the option to do a blend fund, I would usually do that. Now, I really like this Vanguard Institutional Fund. 1, because it's a large blend. 2, look at that expense ratio. It's super low, 0.04%. And then it has a good track record. Okay, so what I would say, if I was investing in this 401k, is I would say for my large U.S. companies, I'm going to invest in the Vanguard Institutional Index. So we're just plugging that fund in there. Okay, let's go to mid-sized U.S. companies. You have 2 options here. You have this Vanguard fund and this Artisan fund. The asset class, you have a value and you have a growth. I like to include both value and growth for each category in my portfolio. So what I would say is include both these funds for your mid-sized U.S. companies, okay? So Vanguard mid-cap value and Artisan mid-cap institutional. Okay, now let's look at the small-size U.S. companies. You got 3 options here. You have 2, for asset classes, you have 2 growth funds and you have a value fund. So what I would do is I'd choose the best growth fund and then I'd take this value fund. I like this Wells Fargo small company growth, although let me go back. Although the expense ratio is a little bit higher than this other one, 10-year track record is a lot better. Okay, so I'd include both these funds in the small size U.S. companies. Okay, now let's look at the international funds. You got 3 international funds. You have International Blend, which takes into account value and growth. You have just this growth fund, and you have this Emerging Markets Fund. What this is a fund that invests in companies in emerging countries and markets. So that's usually Brazil, Russia, India, and China. Okay. What I would do is I was looking at these funds, I would probably go with this American funds one, even though it just represents the growth portion of international. It's got a low expense ratio and a much better track record than the other 2. Okay, so I would use that American funds for my international. Now let's just look at bonds. You don't have much options with bonds. You have 1 U.S. bond fund and 1 international bond fund. So, you know, I won't go into any more than that. Just include both of them in there. Stick the PIMCO total return in your U.S. bond bucket and the Templeton Global Bond in your international bond bucket. Okay. Right now, this is what your portfolio looks like. Okay, starting at the top left, you have stocks. You have large U.S. companies, mid-sized U.S. companies, small U.S. companies, and international. Then you got these funds that represent each one of these categories. Same with the bonds. You got U.S. bonds and international bonds, and you got 1 bond to represent the U.S. bonds, 1 bond fund. You have 1 bond fund to represent the international bonds. Okay, so let's go back to the general asset allocation. Let's say you chose to put 80% of your account in stocks, and 20% of your account in bonds. So this is what it's going to look like. Within the stock portion, you're going to evenly invest in all these 4 categories. So you have 20% in each of these categories. And down here, you'll have 20% in each of the funds. Unless you've chosen 2 funds for 1 category, you'll have 10% in each of those funds. Okay. Another chart with a ton of information. All this is a chart that shows you how much you should have invested in each fund depending on your asset allocation. So start on this left side. You have these different asset allocations, 100% in stocks, or 80, or 60, or 50, or 40, or 20, and how much you have in bonds, okay? And depending on your asset allocation, this is how much I would allocate to each of and the funds, okay? So what I would do is once you choose your asset allocation, come to this chart. Let's say you chose a 50% stock, 50% bond allocation. Oops. Right here, if you can see my mouse, then I would allocate my funds like this to each of the mutual funds. Okay. This isn't a hard concept, but it's a ton of numbers, so it might not make sense. If you have questions on this, just email me after. I'll give you my email address. Okay, just to end, I want to talk about a few things. Always make sure you rebalance your account. This reduces the risk in your portfolio, and it forces you to buy low and sell high. And let me show you why. Let's say you start out with an allocation of 80% stock and 20% bonds, and you did this in 1990. And you didn't touch your account from 1990 until now. You didn't do any rebalancing. Your stocks, if you look on the left, would equal 90% of your account value, and your bonds would equal 10% of your account value. That's just because stock prices rise faster than bond prices. And this is called drift, and the stock portion of your portfolio drifts up and the bond portion drifts down. Okay? So what you need to do is you need to rebalance. So let's say here on the left you have this orange one is a stock fund and this one's a bond fund, okay? And over the year, the stock fund rises and the bond fund drops. What you'll do is you'll sell 10% of the stock fund while it's high at the 60% mark, and you'll invest it in this bond fund that's at 40, and that is considered a low price. So you're selling high on here and you're buying low, and then you'll rebalance, and both of your funds will look like this, the 50-50. Okay. The other thing I want to cover are target date funds. You have the option to do this in your plan. Target date funds just automate everything I just taught you. They base the asset allocation on your retirement year and then slowly shift the allocation to be more conservative as you get closer to retirement. So there's just a few dangers to target date funds. One, or I guess there's one big danger to target date funds, and that's not knowing what that sliding asset allocation will look like. So, for example, in 2008, a lot of people had money invested in the Fidelity target date fund, and they thought it was a pretty safe allocation since they were retired. But really, they had 56% in stock and 44% in bonds. So when the stock market dropped 37% and they saw a 20% decline in their account, they were pretty mad. And that's not to say Fidelity did anything wrong. Their target date fund is just targeted toward toward retirees or people who want to take on more risk. Wells Fargo, on the other hand, puts less of their account stocks and more in bonds. So you just have to know what the target date fund you're investing in is going to do. For example, the Rio Tinto target date fund, this 2035 fund, when you're 18 years away from retirement, you have 72% in stocks and 28% in bonds. Upon retirement, it gets way more conservative. And then 10 years after retirement, it gets the most conservative at 40% stock, 60% bonds. Now, if you're okay with that and that looks good to you, stick your money in the target date fund. For me, I would say that's a little bit too conservative, and so I would go about choosing my own funds in the way we did today. Okay, so that was a ton of information. Hard to do over a webinar. I hope it made sense and gave you an idea of how to choose the funds in your 401k. If you have any questions at all, I want to help you out. So send me an email, kevin@medicuswp.com, and I can kind of take you through that process individually and help you choose your asset allocation, your detailed asset allocation, and the funds that you should be choosing. We are taking on new clients, so if you're interested in working with a financial advisor, once again, just send me an email and let me know. Other than that, that's the end of this presentation, and I want to thank you guys for joining, and have a good one.